All right, I believe control is one of the most important things and important aspects we need as it relates to our wealth. And so I'm going to talk to you about what I mean by control and why I believe life insurance is the greatest asset, not just to grow your money long term, but to control and use throughout your life. Now, you may have seen this drawing from me, but there's really three types of people. And just before I kind of go into the drawing, what I'm trying to talk here is we're not talking about what you do with your money, while that's important. We're rather talking about how you go about doing it. For example, if you own a nice car, I'm not going to talk to you about whether you should buy that nice car or not. You may not be able to afford that nice car, but you're going to buy that car. You're going to make that decision. The next question is, what's the best way to purchase that? And I'm going to literally show you the best way to use your money. I'm not necessarily going to tell you what to use it on. That's a whole nother conversation. But if you're going to make a decision, which we make decisions all the time, use your money in a way that best is most efficient. So the first person here is we'll call him the debtor, and the debtor just goes throughout life struggling. They're going through life, and they're going into debt for college, they're going into debt to buy their car, they have credit card debt, they're going into debt to buy furniture, and they really don't have this money, and they're working so hard to just get back to even. And this person is a debtor to the lender and kind of a slave to the lender, and they pay interest. And so one of the common things here is, Caleb, I don't want to pay interest at all. Like, paying interest is a bad thing. And so what we've been taught this person is to save money, save it up, and just like me, pay cash for college. Save it up, pay cash for a car. Save it up, pay cash for a house. Save it up, pay, and it goes on and on and on. Now, the funny thing here is by paying cash, you're not paying any interest. But by paying cash, you're losing what that money could have earned you the rest of your life. If you saw my video on compounding, it's like if you paid $100,000 in cash, like for something, well, that actually is going to cost you a long term in the future by that money never able to grow for you. So you lose that interest. Now, what we're doing here is one of the best, most efficient way to use capital is understanding the loan provision that life insurance gives. Loan provision is essentially this. You can put your money in a place, and we're going to compound this money. It's not going to be life-changing, but it's going to be a lifetime compounding growth. And if you want to use your money, instead of taking that dollar out and disrespecting what that dollar could have earned you the rest of your life, you can borrow against it and buy that car, borrow against it and buy that house, borrow against it and pay for college, borrow against it, and again, you can use your imagination. Our greatest financial need is using money. So if our greatest financial need is using money, there's no shortage of it's really, really powerful. And so the best way to utilize capital is this way. Now, another thing to think about is if you have access and control of your money, can you not save more? And that's why, again, I'm a huge fan of this idea of not choosing between someday in the future and now in the present, because you can have both. Now, one of the common things here is like, Caleb, why would I want to pay interest to use my own money? And again, it goes back, but I want to answer it because it's asked a lot. Well, you're paying interest regardless. You're either losing interest or you're paying interest. So there's no such thing as a free lunch. This is just a best long-term strategy for short-term. The other question that I get is, all right, Caleb, if I have to pay 5% and I'm only earning 4%, why is that a good idea? Well, it's a good idea because your money is growing the rest of your life. And so yes, on a year-to-year basis, you could in a bubble, you could say that you're behind if you're paying 5% and only earning 4%. But long term, you have to see that, at age 86, if you're still alive, your money is going to continue to grow. And that efficiency is well worth paying a little bit more. And the second thing is, when you borrow against your money, we want to make sure that you use that activity that you borrow against. We want to make sure that's ROI positive. Where a lot of people get themselves in trouble is they utilize their plan and abuse it, and ultimately buy things that actually take money away from them. And again, we can go into that in a little bit more detail, but I want to break down a real estate example because again, I find that in control, it's one thing to draw this out, but it's another thing to show you what's actually going on. So before I get into that, I just want to draw out where your money's actually going. So your money when you do life insurance is going into a plan. And that plan It's going to grow the rest of your life. Now, if you want to utilize things, if you want to buy something, instead of taking that money out of that plan, what you're going to do is you are going to collateralize that money with the insurance company. So you're going to borrow from the insurance company. This is what the big box is. And they are going to use your cash value or your equity in your plan as collateral. So let's say you want to buy a car, and you buy that car, and let's say that car costs $20,000, and you have more than $20,000 in your cash value. So your money is, again, still growing. You take a loan from the insurance company, not from your own money, and then on your time period, however you want, you pay back the insurance company and they reduce your loan. And so it's essentially like if you pay that car loan back in 3 years, now your lien on that $20,000 lien on your policy decreases as you pay back the insurance company. So it works a lot like a line of credit. Maybe it works a little bit like a credit card, even though we're not talking about those interest rates and all that. It's like when you pay it back, it usually frees up credit. So that's kind of how it works, kind of big picture. But let's go back to that $100,000 example that I talked about in the compounding. And let's say you have an opportunity to buy a house, and it'll take you 18 months, but then you'll flip it. Okay, so you're gonna buy that house, you're going to, it's gonna cost you $100,000 to get in, and let's say in 18 months, you can like double your money. Okay, we'll just say $100,000 worth of profit. That might be a terrible example, but this just represents an opportunity. You could be a business owner, regardless of what this opportunity is. It's not a car, it's actually an ROI positive opportunity. So your $100,000, if we go back to the compounding idea, is growing. So over 10 years, it's gonna be 148, and over 20 years, it's going to be 219,000, and over 30 years, it's going to be over 324,000, and over 60 years, it's going to be over $1 million. So you get the fact that your money is continuing to grow long term. Now, on the flip side, let's say the insurance company is going to charge you 5%. So, okay, that's more money than you're earning, but your 5% interest over 18 months on $100,000 is going to be $7,722, okay? So that's the money that you would have to pay the bank, $7,722. And in that opportunity that you got, you're going to be able to profit $100,000 at the end of 18 months, okay? Now let me ask you a question. Would you be willing to pay $7,722 in interest to have whatever opportunity you're going to make, in this case, $100,000, and this is the big thing, and your cash value and your cash in your policy continuing to grow? That's the power of efficiently borrowing against your money. And obviously, I showed an example of you earning a profit here and your money's still growing here. So it's like a no-brainer. Like, absolutely, I would pay that because I know my money long-term is growing, and it's giving me the ability to jump on an opportunity where I'm going to double my money. Now, on the flip side, a common question is, Caleb, like, what if you invested in an opportunity that, made you less? Like, you actually made $6,000 in profit. Well, like, you had to pay $7,722. Would you want to pay that money? Would you want to pay $7,000 to make $600? No. So there comes into like when we use our policy, we have to understand that there's profitable asset-based ideas of money being put in our pocket. There's also things that we could use our policy that actually don't serve us well. So we have to, it's not like a magic bullet, get rich quick, but what I will say is, don't underestimate your cash continuing to grow. So even if you buy a liability like a car, or even if you go on a vacation, you just have to understand that you're not necessarily profiting by taking a loan and going on vacation, but your money is still growing. So it could be still the most efficient way to buy that car or go on vacation. In summary, control is incredibly important. we want to make sure that we can maximize it in your own life. And so that means putting as much money in a place you have control that will grow the rest of your life, and know that you have complete access to use it. You don't use your money, you use the insurance company's money, and at the end of the day, you're either going to pay it back or you're going to pass away and your death benefit's going to pay it back. And regardless, it's a really, really powerful, whether you're using it in retirement or that you're an entrepreneur or want to pay off debt.